Today, we're going to talk about one of the most disastrous financial crises in history, the Great Depression. So, if that sounds interesting, make sure to like and subscribe. It really helps out a lot. And let's get into it. When people think of the worst financial crisis, they usually think of the 2008 financial crisis, or perhaps the dot-com bubble of the early 2000s. But compared to what happened in the 1930s, these are just small speed bumps on the road of capitalism. In this video, we'll look at what caused the Great Depression, how bad it really was, and most importantly, what we can learn from it. As always, I will try to keep things as simple as possible so even your grandpa could understand them. Before we start, I have a question for you. What do you think is the best way to avoid a massive economic crisis? A. Nothing. Just let things happen. Or B. Proactive policy responses. Well, if you chose B, you'd be right. Well, at least mostly right. Let me explain. Basically, since the Great Depression, all major economies have tried to learn from what happened back then. They put policies in place to stop something similar from happening again. But obviously, we've had some recessions since then. But compared to the Great Depression, those were very mild. But now I think it has time to go a bit more in depth and take a look at what happened back then. So let's do that, as you probably know. The Great Depression started with the stock market crash of 1929. But while the stock market crash certainly made things worse, it wasn't the main cause of the Great Depression. Rather, it was a symptom of a much bigger problem. You see, there were two big economic bubbles in the 1920s. One was in the stock market, and the other was in the agricultural market. Basically, throughout the 1920s, farmers borrowed huge amounts of money to buy more land. And by 1929, farmland prices had soared, nearly tripling from 1910 levels, fueled by a frenzied wartime boom. Of course, this meant that when the bubble burst, farmers lost their farms and went bankrupt. Now, this wouldn't have been such a big deal if only farmers were affected, but the thing was that 2/3 of all US adults were farmers and farm workers. So, needless to say, this hit the economy hard. Now, this isn't great news for an economy, but it would have been much worse if it wasn't for the Federal Reserve. You see, up until the Great Depression, the Fed's job was to ensure that there was enough money in the banking system to keep the economy running smoothly. So when the bubble in agriculture burst, the Fed stepped in and lowered interest rates to encourage banks to lend more money. In fact, during this time, they lowered interest rates 7 times. But here's the thing. Lowering interest rates is a good idea in theory. In practice, it didn't really work. Why? Well, the reason was that commercial banks simply didn't want to lend money to farmers. And there's one big reason why. After the agricultural bubble burst, farmers weren't really reliable customers. They had gone bankrupt after all. So commercial banks preferred to lend money to factories and businesses instead, which seemed much less risky. This is where the Fed made a huge mistake. You see, the Fed pressured commercial banks to lend money to farmers anyway. Might not seem like a big deal, but it actually was. Why? Well, commercial banks simply did not trust farmers, and for good reason. So what they did is that they took the farmers' loans and lent them to businesses instead. This might not sound like a big deal, but it actually was. See, while farmers were bad customers because they were broke, businesses were happy to take out loans. In fact, business loans increased by over 100% to power factories and stocks. Of course, this led to another bubble, this time in the business sector. But while bubbles might seem like a simple thing, in this case, it wasn't. In fact, it would eventually lead to the stock market crash of 1929, but the Fed still wasn't worried. You see, the Fed thought that the stock market crash was just a minor event and that the economy would quickly recover. But they were wrong. After the crash, people lost a lot of confidence in the stock market and banks, and so they started withdrawing their money from banks. This wasn't a big deal at first, but it soon became one. See, banks were legally required to keep 1/10 of their deposits in gold. If people wanted to withdraw their money, they had to melt down some of their gold bars to give people their cash. But there was a problem. Banks had given out so many loans to businesses that there wasn't nearly enough gold to go around. In other words, the whole banking system was built on thin air. And now that people were withdrawing their cash, banks simply didn't have enough gold to go around. This is what we call a bank run. And if you've ever seen one of those action movies where a bunch of people are trying to withdraw their money from a bank at the exact same time, well, that's exactly what happens. Of course, The banks couldn't handle all of that, and they collapsed. In fact, between 1929 and 1933, almost a third of all banks failed. With banks failing left and right, people were getting desperate. One person might not have noticed this, but once you started seeing headlines like this, it became pretty clear that something was wrong. And as the situation got worse, people became even more afraid, so they withdrew even more money. And as more and more people withdrew their money, more banks failed, and things just kept getting worse and worse. To make matters worse, the president at the time, Herbert Hoover, was completely clueless. He had no idea how to fix the situation. In fact, he didn't even think that the government should intervene. At first, he thought that the economy would quickly recover, and when it didn't, he blamed it on the media. He also did something else that ended up making things much worse. After the stock market crash of 1929, Hoover called an emergency meeting with business leaders and told them to keep wages high and not lay off any workers. He thought that this would help the economy because people would still have jobs and thus continue spending money. But this was a huge mistake. You see, while it's nice to have a job, it's better to have a profitable business. But when you force businesses to pay high wages to workers who aren't really needed, their profits go down. If their profits go down, they have less money to invest back into the economy. Pretty soon, the whole economy ground to a halt. Things didn't turn around until Franklin D. Roosevelt became president. You see, FDR understood that the government had a responsibility to help people. And so he passed a series of laws known as the New Deal, which basically restructured the entire American economy. These reforms included government-sponsored jobs, Social Security, and the FDIC, or Federal Deposit Insurance Corporation. The FDIC basically guaranteed that people's money would be safe in banks, which is why today, even when banks fail, depositors don't lose their money. And these policies worked. By 1941, unemployment had dropped to 9.9%, which at the time was considered pretty low. And that's what happened. The Great Depression was the worst economic crisis in history. In fact, it lasted for 10 years. During that time, GDP fell by 30%, unemployment rose to 25%, and prices fell by 22%. In fact, the only reason why the Great Depression didn't last even longer was World War II. You see, during the war, governments spent a ton of money on weapons, which created a lot of jobs and boosted the economy. So yeah, the Great Depression was bad. But what does this mean for us today? Well, I'm glad you asked. First of all, this shows us that no matter how strong an economy is, it can always be improved. Second, it shows us that bubbles are not healthy for an economy. And finally, it shows us the importance of responsible leadership. If FDR hadn't taken quick and decisive action, things could have turned out very differently. I hope this video has been helpful. If it has, please make sure to like and subscribe. It really helps out a lot. With that being said, I'll see you next time. The views and opinions expressed are based on my personal understanding and are not intended as financial advice. Please conduct your own research and consult with a qualified financial advisor before making any financial decisions. Since you've stuck around till the end of this video, it's clear that you found this topic intriguing. I think you'll definitely want to check out the videos popping up on your screen now. Explore even more fascinating topics in finance that might just challenge your perspective. And if you enjoyed this video, make sure to like and subscribe for more videos that break down complex and foundational topics in finance. Thanks for watching.